Hey everyone, happy Thursday, January 29th. It's about 7:30 in the morning on the West Coast and it's time for another market update. Well, it was a relatively quiet week in the markets, and it's interesting because this could have been a pretty hectic week because yesterday the Fed ended their most recent 2-day meeting. Remember, the Federal Reserve meets for 2 days. At the end of that meeting, they come out kind of like Groundhog Day and say whether or not they're going to be cutting rates or not cutting rates. They also have a press conference. They also release a statement and all those kind of things. So yesterday they came out, and going into this meeting, it was basically markets were 100% sold on the fact that they were not going to cut rates, but they were also not going to raise rates. So that would be a pause. So basically keeping rates where they're at. And that's exactly what happened. They came out. They did not raise or lower rates. The statement they released when they make their announcements was a little bit more hawkish. Some of the tone was a little bit more maybe what we wouldn't like to hear in the markets. The markets reacted a little bit, but then afterwards, like I mentioned, Chairman Jerome Powell has a press conference and answers questions and things like that. And his tone in the press conference was a little more dovish, so a little bit more friendly to the markets and in the markets like that. So it kind of evened out. So no big surprises there. Really, it comes down to what's going to happen next. Are they going to cut at their next meeting, which comes in March, which we'll talk about? Right now, the markets have that at an 80% chance that they will not do anything again. They'll continue to pause. So obviously, we would like them to cut at that March meeting. So we're going to have to keep an eye on all the data. Like we've talked about, the inflation data and the jobs data are the most important because that's what the Fed's paying attention to. So that was the first thing. And again, that normally this could be a big day where market rates go way up or they go way down and things like that. But this one, like we've talked about, the markets usually know what's going to happen by the time we get to the day when the Fed makes their announcement. So any negative or positive movement had already happened. And in this case, so it had already baked in the decision for over a month now that, hey, the Fed's going to probably not cut or raise. So this is what we're dealing with. Next thing we got. So we got November appreciation. So it came in, it's the fourth straight month that it came in positive after 5 months in a row previous to that where it came in negative. So this is the Case-Shiller numbers. Case-Shiller is kind of the gold standard for a home price appreciation. Again, this is for November, so it's dated information. This comes out a little bit later. And so this came out a month over month seasonally adjusted at plus 0.4%. Year over year now it's at plus 1.4%. As you can see, it's pretty in line with the 20 city index. And then the other one they come out with is the FHFA. FHFA is, you kind of look at it as maybe for lower price homes because it does not include cash deals and it does not include jumbo loans. And that came in higher than expected too at 0.6, and that's at plus 1.9% year over year. So all good there. And if you exploit that out, if it went up plus 0.6 per month, that's over 7% for the year. So that'd be amazing for homeowners in a lot of parts of the country. So again, good to see after it kind of started to slide a little bit with the market slow and rates high. Now it's the fourth straight month where it's climbed, and really this is a time of year where a lot of times it's not going to climb too much, or it might turn negative because it's not selling season. Not a lot of people are looking to buy homes. So really what you could say is that, the last 4 months, it's rates coming down a little bit from mid sixes to the lower sixes has kind of unthawed the market a little bit, more sales, and it's pushed home prices up a little bit. So good for current homeowners, not necessarily good for you that are looking to buy a home, because again, if you wait too long and rates come down too much, then home prices are going to skyrocket again. And then you might be saving money on your interest rates. But if you are paying, 10, 20% more for the house, then that is going to counteract that, and maybe even payments going to be higher. So next thing we got initial jobless claims. So initial jobless claims keep coming in really low. Keep in mind this is when when people file for unemployment, these are new claims. So someone new filing for unemployment, that was at 209,000. Really low numbers, for a while now. The estimate was a little lower than that, so I guess this was a little bit of a positive for us, I guess, because again, we don't want necessarily people to lose their jobs, but the weaker the job market looks, the more likely the Fed is to cut rates. And the continuing claims are still in the 1.8 million range. So really, what's been true for a while is still true now, where it looks like companies are trying to hold off laying people off, but once people do get laid off, they're having a harder and harder time to find a new job. Next thing, what do we got? So where does that leave us? So the average 30-year conventional, it's about 6.16. It hasn't come out yet today, according to this lender's survey, but it's probably going to be right about then. Not too much is going on this morning. The previous last week we were at 6.19, so we came down a little bit. So we're, like I said, we're down in that lower part of the sixes, We got under 6. We got to 5.99 for a few hours one day a few weeks ago. But it'll be really nice, obviously, to break below that 6 number and kind of comfortably get in the fives. And that would probably, again, cause a pretty big jump in activity, which good for current homeowners and good for realtors, things like that, but not good for people that are looking to maybe have home prices come down because that would cause home prices to go up. So next thing, so important dates upcoming. We got the BLS jobs report coming out on February 6th. That's the big one. That's the one that everybody looks at to decide what's going on in the markets. And then later in the month, we got PCE in February. It's the Fed's favorite form of inflation. And like I said, they're not going to have their meeting until March 18th. So we'll get another BLS, another PCE, some CPI, other inflation data. We'll get lots of reports between now and March 18th. And obviously, a lot happens in the world between March 18th and now. I saw that there was some talk of war with Iran, and that made oil prices go up. Oil prices go up, make gas prices go up, and a lot of inflation in this country is kind of comes off of gas, even though they try to cut it out. Any goods that get to this country at some point are on a truck, being delivered where they're going, and obviously that takes gas in most circumstances. So that is why we don't want to see a war in the Middle East, because that would cause oil to go up and inflation would go back up, and the Fed wouldn't cut rates. So all those kind of things, obviously, besides the data, is that world events. And the world's a crazy place these days. So let's hope that nothing, no wars happen, nothing like that. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.